Hi everyone, my name is Lucian. Most of you know me from Twitter as Triangle Investor. In today's edition of CEO and Market Expert Interviews, I'm joined by Bram Vanderelst. Bram is a well-known uranium name in uranium business, and he's a uranium trader and head of Curzon Uranium, a company that is involved in nuclear industry, physical uranium, offtakes, financing, and much more. Bram, it is my pleasure to have you in the show. Welcome.
Thank you very much, and pleasure to be on the show, Lucian.
Thanks. Bram, when, why, and how did you enter uranium and nuclear energy business? And please give us your background.
So I kind of rolled into the sector like most people do in 2014 when I started working with Itochu, one of the larger traders in the space. And I initially was responsible for the European market mostly, or the European and African market, and really spending a lot of time with the utilities, which is what got to where I got to know the utility side of things very well and understood their concerns and their issues. And then in 2017, together with my business partner, we started Curzon Uranium, where we saw a need for the market to consolidate. We saw the need for the market to incentivize new production from junior miners. We looked at the long-term need for nuclear energy, essentially, because this was all before Russia invaded Ukraine and before energy crisis and even before renewables took off in a big way. But we kind of anticipated that nuclear would make a comeback. Nuclear and uranium as such were unloved and underinvested in. And so we started Curzon Uranium on the back of that. I think we started Curzon Uranium when the price was around the $17, $18 mark, so really at the low of the market. And it was a tough couple of years because the market didn't move at all. I think we traded in a thin band between 20 and 21 for better part of 1 year. But it allowed us to really focus on what we are doing best at Curzon Uranium, which is spending time with the junior space, spending time with the producers, really trying to help people, trying to find solutions to their problems. We signed a bunch of offtakes at the time as well to help incentivize new production, to help incentivize miners to get to market. And we've essentially been running the company as a trading company since 2017. I think nowadays we're pretty much a household name. We're very well known in the sector, both on the producer side and on the utility side. We do a lot of business globally. We cover anything from Japan all the way through to the Western United States. We've got people in various different countries, and we're still to the core, we're still that same company that is focusing on the macro. So we spend a lot of time doing our own supply demand. We spend a lot of time looking at the macro picture and what is the outlook for uranium, what's the outlook for energy in the world, what's the outlook for mining. But obviously we also spend a lot of time with our customers and our clients, whether it be producers or the utilities. So that's in a nutshell what we do on a day-to-day basis. It obviously encompasses a lot more than I just described, but that's really what we do on a day-to-day basis. And I run Curzon Uranium essentially.
Yeah, great background. Can you explain just a little bit more in which segments of uranium and nuclear energy business is your company active? And I mean, what is your focus? What segment generates the most revenues for you?
So by far it would be U3O8 or natural uranium. That's where our focus is, and that's also because that's where the most liquid market is. As you go downstream in nuclear fuel, you go from nuclear or from natural uranium, down to conversion, enrichment, and into fuel fabrication. And the market gets less and less liquid and more tailored towards specific reactors down that value chain.
Exactly.
So we've purposely chosen to be more active in the uranium space, in the natural uranium space. However, we also do business in UF6, in enrichment. Not so much or not at all in fuel fabrication, because fuel fabrication is a very technical and tailored towards a specific end client kind of business, which with large scale. So that's something that we don't really get involved in. But anything from the mining side all the way through to the enrichment side is what Curzon Uranium does.
Yeah, that brings us to your cooperation with Swiss physical fund Zuri Invest. How is that working? Can you describe what services are you providing to them and explain how is that fund working on the market?
Yeah, very well. So we launched, actually Zuri Invest launched the Zuri Invest fund in, I think it was April or May last year. And essentially, we've been working with Zuri Invest to set this thing up for the better part of about a year. And the whole idea behind it was to give investors or large size investors, hedge funds, family offices, larger high net worth individuals, access to the physical market without any real hurdles. It's something that is very hard, and as an investor, you know this very well, that access to the physical market is very, very difficult. There's obviously a few other avenues that somebody could take, like a yellow cake or a Sprott, but they come with their inherent problems because they trade at discounted net asset value more often than they should. There's no redemption feature. So the whole setup of Zuri Invest was, the main purpose of the Zuri Invest fund was really to have a vehicle that trades at net asset value all the time and that trades at the price of uranium, essentially. And you can see from their website and from how it's set up that's actually been achieved. So you can track that the price of the AMC or the unit tracks the price of physical uranium, which is exactly what we envisaged it would do. We see nowadays as well, or at least I've been told by Patrick at Zuri Invest, that there's a lot more interest from investors essentially across the world, because they're now seeing that with price moves, that the Zuri Invest AMC tracks the uranium price very neatly, and that with Sprott and Yellowcake and other vehicles, as an investor, you're much more exposed to your entry time. If you enter at a big discount, you could outperform. But if you enter at a flat price, you could also outperform in a negative way, because it starts trading at a discount to net asset value again. And so I think the AMC does what it needs to be doing. As I said, it's very tailored towards larger size investors, so it's not retail focused, unless somebody in a retail kind of fashion has $100,000 to invest. But it's really giving access to the large size investors to the physical market. Because what we see as well these days is that as a fund, or the larger funds at least that are looking at the sector, they are making the consideration, what should we invest in? Should we invest in the equity side, in the physical side through one of the vehicles, or in the physical side directly? Because that's also a possibility. The equities is good, but as a large size investor, you have only so many equities you can invest in because of the size of the market. A Cameco, a Kazatomprom, you can quite easily deploy some capital in, but if you go down the tier 2, tier 3 equities, it's hard to deploy decent capital. Yeah. And then if you want to go on the other end of the spectrum, if you think about actually making investment in actual physical uranium, it requires a lot of time to enter the market. You need to set up converter accounts, you need to do diligence, you need to be able to trade with the counterparty. So there's a whole range of things that need to be done. And essentially you require somebody that follows it on a day-to-day basis, a uranium trader. So most funds are now looking at that sort of medium sectors, like where's the price appreciation going to be the largest, or at least it's going to be the most directly linked to what the underlying is doing. And that is through the funds, or the physical funds and the physical vehicles. And that's where the Zuri Invest AMC comes in and plays an important role. So
funds are adapting to the status on the market, so to say. I mean, will Zuri stay in the same format, or we will see some large, let's say, changes?
No, Zuri's format works really well, and Zuri's format will stay the same. The only thing that Zuri will, or that they're trying to achieve at the moment, is that they will open up the AMC to US investors. As with anything in the world, getting an equity or launched in the US is a very difficult problem, or very difficult undertaking. And so that's something that Zuri Invest and their partner Gen2 is working on actively to open that up to US investors. We don't have any visibility over when that's going to be, so I can't give you any timelines, but that's the one main thing that they might change. But essentially the rest of the world can invest in this vehicle, and the vehicle works as it should. So there's no need for Zuri Invest to change anything on the vehicle itself and the way it works.
Yeah, it makes sense. Bram, I have a question that I ask my guests who are very familiar with the market and have the best inside view of things, just like you. And that is, how tight is uranium market at the moment? How many material is available out there on the spot market?
That's a very good question, and you'll get an answer or a different answer depending on what week you're asking that question.
Yeah, definitely.
But I guess the general trend is that the uranium market is getting tighter and tighter. As we all know, there's a lack of production, and there's more demand for material than there is production, and it can't be covered by secondary supply. So what we see across time is that the market is getting tighter and tighter, and we see that as a physical trader that buying large size tickets or larger size volumes is very difficult. 5 years ago, you could buy £1 million without a problem. You go in the market and have it sourced within a day. Now you'd have to work at it. But also the market, in that intermediate period of time, you kind of have the ups and downs of the market. And what you see is that in certain weeks, you actually have a decent amount of liquidity where you can buy 500,000 to £1 million within a fairly easy time frame. Whereas other weeks, you can barely buy 100,000 to 200,000 pounds, and the market moves a couple dollars on the back of it. And that's the reason for that is twofold. One is you've got the uncommitted producers, most notably the Uzbeks and maybe some Australian material, that at discrete points in time still enter the market. And at those points in time, that material goes typically via a trader or directly, needs to be deployed into the physical spot market. And that is just material that needs to be placed that doesn't have a home yet. And therefore, traders pick it up, or people can pick it up relatively easy. Then the other times that we see the uranium market being a bit more liquid is at times like that we're currently living through, which is when the market has had a real big jump in prices, like we saw the last month when the market went all the way up to 73. And in that rally towards higher prices, you see that ultimately people start taking profits. And it's the same on the spot side, on the equity side, but it's all the same on the physical side. All the way through that rally, you see, especially traders like ourselves, taking positions on the physical market. And as a trader, you're not a consumer of material. Ultimately, your material needs to go into either a fund or a utility or a final end destination. So when traders start taking profit, that's when we see a bit more liquidity on the market again, which is also why we currently saw the price drop from 73 to about 68, 69, where we are right now. It's essentially profit taking by traders and other entities in our market. And during those times, that's when you find the liquidity. So as a trader, as much as doing or looking at prices, you need to look at the liquidity in our market. You need to find the liquidity and grab the liquidity when it's available. And then you need to provide the liquidity when the liquidity isn't available. So, and that's part of our job to time that very well, so you can actually make money on the trading side.
Great answer. So the physical part of the market is acting like equities. When it goes up sharply, profits are taken.
Yeah, correctly. And that's, I mean, any market worldwide will act like that. There's always a level at some point that somebody will take profit. What we see, and it's different entities that drive it. So what we see now, and to take last month as an example, is that utilities were the ones that initially spurred the market on. Cameco said they had a lack of production this year. Utilities got a bit worried. There was a flurry of material or RFPs by utilities and material being bought by utilities, and that really kind of jump started it. And then the traders jump on it, and the funds jump on it. Sprott kind of started raising money again, so they started buying material. And then at some point, somebody's going to sell. And it's always a big question, who is going to sell and where. And this time around, we saw it wasn't necessarily the traders. It was kind of the other vehicles that started to sell, like the sort of the physical hedge funds that started to sell some material. We saw people like some equity listed vehicles or equity listed entities that were sitting on some physical uranium that started to take some money off the table. That then ultimately, like the cycle turns. At some point, the utilities also say, look, the market has gone up $10. It's too expensive for us right now. We'd rather sit back and wait. And that's typically when the market turns and kind of you have a bit of a dip. But all of that is in an underlying bullish market. So essentially the trend, or for you, the trend would be like that. And you'd kind of fluctuate around that trend, but the trend line is still very much up.
Yeah, that's exactly what I wanted to hear. Bram, give us an overview of the long-term deals activity at the moment. Are utilities aware of the uranium market tightness?
Yes, utilities are by now definitely aware. It's taken them a bit of time to catch up for various different reasons, but they're definitely aware of the tightness. And utilities see it directly as well when they enter the market or when they approach producers about long-term deals. The ones that did 2 years ago, they signed contracts with Cameco, Kazatomprom, Orano, the bigger guys in our sectors. The ones that approach these same entities right now, they get a very different response. They get a response, well, we can supply you, but it's going to be on a market-linked basis, or you're going to have to really pay up so we can incentivize new production. And that kind of then gives them a second option. The second option is, well, what about the carry trade? Can we engage with a bank or a trader who can actually buy material in the spot market and then carry it for us? But with rising inflation rates and with essentially the tightness in the physical spot market, the carry trade isn't so attractive anymore, at least not on a financing basis. And then the third option is that you go into the what I would call the lower tier producers, so the greenfield, brownfield producers. And that's currently what we see. We're seeing a lot of the brownfield and starting to see some of the greenfield producers being successful in signing contracts with utilities. And that is because utilities are starting to see that they're not getting the material they were once having from the major producers. And that to utilities is a very clear sign that the market is getting tight, that they're not getting the same responses they were getting on RFPs 3 or 4 years ago. Another really good indicator from the physical side is when RFPs are launched, they typically ask for flexibility on pricing, floors and ceilings. They ask for flexibility on options, so they can flex it up and down. The response that those utilities are getting is an indication as to the tightness of the market in the long-term basis. If the producers aren't willing to give flexibility -20 plus 20% anymore, that means that the producers are kind of dedicating only specific parts of their book to these RFPs and aren't all that flexible anymore. Again, that shows tightness. And so through our conversations with utilities, we see that they understand this. They understand that the market is getting tight. They understand that there's the need for new production. In some shape or form, most utilities either run their own supply demand or have third-party supply demand sources. And so all of those sources show that there is a need for new production. I think from what we're seeing, the big divergence between utilities is the ones that are understanding that there's a tightness, but I think that the tightness will be resolved by new production, either coming out of Kazakhstan, from Canada, or all of these greenfield projects. And then others that are a bit more what I would call realistic in terms of the mining side, and they're saying, well, that there is material in the ground, that's not a problem. It can come out of the ground, but the question is about timing and the incentive price and the incentive timing for that. And I think those utilities are the ones that are currently a bit more active in the market, and they're kind of wondering, well, especially in the near term, 24 to 26, this is when we really need to make sure that they're fully covered. And with each announcement by a miner that has difficulties for one reason or another, those timeframes start slipping, and you need further out coverage. And so to me, the question really is like, when you sign a contract with a brownfield or a greenfield producer, how certain is it that you're going to get those pounds? And on top of that, and probably more importantly, who's taking on that risk? Because as a utility, you might actually be quite comfortable. You might say, I've signed a contract with a junior producer, doesn't matter which one, but a contract set is a take or pay contract. And so if for whatever reason that junior producer doesn't produce, and it can't claim force majeures because the contract is very well set up, then it's up to the junior producer to go source the material in the market, and not up to the utility, which is an important factor, because that means that as time frames are getting delayed on the junior producer side, it might not be up to the utilities to source that material, but it might up to the junior producers. And then there's a big question about credibility, like what is the credit rating of these junior producers? To what extent can they weather a storm like that if it's 1-2 years? So I think those are all kind of elements that are currently being played out. But the long and short of it is that we see utilities coming out for material in bigger ways than they have been in the last few years. I think this year, like, I don't know off the top of my head what the contracting rate is, but it's getting to replacement rate and beyond replacement rate already, which is a good sign.
Bram, long story short, utilities are more worried about securing supply and quantities than the price they are paying.
At the moment they are, yes, absolutely. Price is obviously important, and it will always be important. But we see utilities now making decisions where they say, we just need to make sure that we've got access to the material, and that's the most important bit. And we will just need to take whatever the price is. And quite frankly, the price isn't all that bad. If you launch an RFP and you got 20 respondents or 10 respondents, let's say, there will most of the time be 1 or 2 that are relatively well priced and that are in line with the market. There's going to be 8 that might say, you know what, I'm just taking a punt and I'll price it at $90. And if they take me, great. If not, then I won't be supplying them. And so that's also another indicator for utilities, like how many competitively priced offers do they get. But still right now, you still see that the offers are somewhat competitive. It's really the question mark is about who is giving that offer. There's a big difference between a chemical giving a fixed price $70 offer or a junior producer with just a DFS giving a $70 offer for 27, because it's about certainty and about security of supply. So that's really what we're seeing at the moment.
But who are the buyers on the spot market at the moment? And if you can talk approximate percentages, who is out there most aggressive buyer at the moment? Is it the funds, traders, companies? Who is the most aggressive buyer at this moment?
I wouldn't call it aggressive. I would almost say funds are typically a buyer that once they make a decision, they're going to buy irrespective of prices. So when spot less so in the last few months, but some of the hedge funds, some of these physical funds, they will just make a decision. They'll go out and buy whatever the price is at that day. So in a way, you can describe that as being aggressive. Traders are more, they're trying to time it, and they're trying to make sure that they're getting the lowest price, but that's definitely not always the case.
Of course.
And then utilities are much more discretionary. So especially in the spot market, utilities, they try to dip into the market when they see an opportunity. As a utility, 90% of all utilities don't have to buy in the spot market. They're adequately covered with inventory, they're adequately covered with on their reloads. So whether they buy in September, October, November, or December, it typically really doesn't matter. So they'll try to look for some weakness in the market, but that weakness sometimes works against them. And what I mean with that is we've had plenty of conversations with utilities where you go, the market was 45, coming from 30, and you see them, a utility wants to buy and they say, no, 45 is too expensive. It was 30 like a couple months ago. And then they kind of like readjust their thinking, go like, actually 45 is not too bad. But by the time they think that the market's already 50 or 55, and then they think 55 is too expensive. And so they're kind of always lacking, or they're always lagging behind the increasing prices. And again, it's not a one size fits all. Some utilities they'll make a decision. They say, just cover something, let's go in the market and do it. Other will always kind of be lagging behind, and then they'll ultimately sign a longer dated deal at higher prices. So it's hard to really say put a percentage on aggressiveness. But the spot market has always been and will always be dominated by traders, by carry traders, by funds, solution providers, whatever you want to call them, but people who are not necessarily, or not the utilities as such. Utilities are much more discretionary in the spot market. Yeah,
it makes sense. Spot is up long term too, but we have to keep in mind the incentive price of production, like you mentioned before. Are we there yet or not? In my opinion, the incentive price for uranium production is around $80 per pound, but some say even more, of course, depending on a lot of factors. So what's your take on this?
I think if you look at the marginal cost of production, you're probably looking at that $18 to $90 per pound to fully fill the supply gap right now. If you look at, are we there for certain projects and certain suppliers to come online with more production? Yes, absolutely. The Kazakhs can, as they've recently announced, they can ramp up to 100% of their subsoil agreement. They could go higher based on pure cost pricing. But there's other incentives. The Kazakhs won't do it because they're taking a value over volume approach. Are we there for big investments? For example, the chemical ramp up of McArthur River. I think we're probably more or less there in terms of pricing, but it's not just a pure pricing decision.
Of course.
But then if you look at like some of the lower the lower resources or the lower percentage resources in Africa or other places, are we there on incentive prices? No, probably not. I think we probably still have like $10, $20 to go in terms of like real incentive prices. And then it's not a question of just hitting those numbers. It's a question of hitting those numbers and being able to sign contracts at those numbers. And as I explained just now, what we see typically is to be able to sign contracts at those numbers, you need to stay at that level for a while. So you need to get the final buyers, which are the utilities, comfortable that those are levels that we're not going to breach below in a big way again, and that are going to be there to stay. And that's when these kind of levels are getting contracts signed for a longer period of time. Mm-hmm. So I think we're still a bit of time away from real proper incentive pricing that will fill the full supply gap, or at least marginal cost of production. But that doesn't mean that we're not going to see projects going ahead based on the current pricing, because lower tier production cost can come online given current pricing levels.
Yeah. Bram, what is your take on Niger's situation? How do you think that this situation will unfold? I mean, we saw recently a news release where Global Atomic finalized letter of intent for its third supply uranium to North American utilities. Looks like it is business as usual for utilities in their view of Niger's situation. If you look at this news, what's your take on Niger's situation and this news?
I would take that with a grain of salt, because you don't know how that contract is structured. A contract can be structured in a variety of ways, and a contract can be structured in such a way that that there's no if there's no production, that there's no need to supply, but a contract can be equally structured that it's a take or pay contract, and that it falls to global to supply regardless of whatever the situation in Niger is. So this is something that you'd have to take with a grain of salt and try to read the tea leaves through that contract, what's happening in Niger. Unfortunately, I don't have a direct line to Biden or Macron, so I don't know what's happening in the background in Niger. But our take is that it's very high-level geopolitical. There's obviously a lot of forces at play in that part of the world, and this is over and beyond what happens on uranium. The US has got interest in sub-Saharan Africa that they want to protect. The French obviously want to protect their interest, not only from a uranium perspective, from a military perspective as well, and they don't want to spread it or let the anti-French sentiment further spread in sub-Saharan Africa.
Yeah, but that is more anti-French sentiment, not anti-West sentiment.
It's an anti-French sentiment, yeah. Correct. But there's other entities around the world, not to name the Russians, that play a role in that. And I'm not saying that the Russians have orchestrated the coup, not at all. But when there's weakness on one side, there's opportunity on the other side. So I think our take on Niger is that this actually might be dragging out for much longer than most people anticipate. It is, if you purely look at it from a simple uranium perspective, it's very clear. The world needs the uranium, Niger needs the uranium, it's a big part of their GDP. So the logical assumption is, well, they're going to go back into production at some point. But because it's much more broader and geopolitical, there is conversations going on in the background that that we're not aware of, and that probably nobody's aware of, aside for the high-level people that are having those conversations, that have nothing to do with uranium. And the outcome of those conversations can have an important impact on uranium. If for whatever reason the French do a deal where they relinquish their mine and it goes back to the state, I'm making it up at the moment, but then that has far-reaching consequences for the uranium sector in Niger. And not only for Orano, but also for all the others. So there's a lot of, I'm speculating right now, but there is a lot of uncertainty. And at the moment, from what we're seeing just through reading the news and everything, I don't see any real near-term solution. I think the situation in country needs to be resolved first, to then even start looking at the resource sector in the country, and then specifically on uranium. And then, as you pointed out earlier, you've got all the more direct effects to those mines, which is the financing issues. There is still there's still no corridor to bring any real material into the country or out of the country, so any consumables can't get into the country. Global probably is going to run out of the tools or the explosives to dig further or to go further underground. So there is a lot of issues, and it's really about timing. I think we are a long-term believer in Niger. I think Niger has a place to play on uranium and in as a resource country, but it's very political, and I wouldn't really want to call that, because who knows? As I said, I don't have a direct line to Biden or Macron.
Yeah, would you say Orano recent move, I mean, the news we saw that they signed a protocol for development and operation of uranium mine project in Mongolia is caused by Niger's situation, or do you think that happened?
No, Orano has always had has put Mongolia quite high on their priority list of developments. So Mongolia was always number 2 and number 3. I think Mongolia has now jumped or leapfrogged Imaren. So Imaren in Niger was a project that Orano really considered. They'll probably reconsider that, and they'll probably first go develop Mongolia before they go back to Imaren. But if you have a built mine like Somari right now, that obviously should stay your main focus and your priority. So I think it's a bit of both. The fact that Macron has really made an effort to meet the Mongolian president and really is driving that that project for Orano, that does tell us that Orano is reallocating its resources and is at least looking at their options. And they've got limited options. They've got stuff in Canada, but as we all know, Canadian exploration to mining is taking a long time, and they've been less and less inclined to get into Canada recently, or in the last 5 years. So they've been looking at the countries around the world, but some of those countries are looking shaky. Mongolia doesn't have the best history in terms of nationalism of resources.
Yeah.
So it stays a bit of a wild guess where Orano is going to go and where they're going to go find their uranium. But I would imagine indeed that Mongolia is higher up on the list than Niger, obviously, right now.
Do you believe that Mongolia could be the next big player in uranium production? I mean, in the next 15 years?
I think they could be relatively well-sized. Mongolia has got some really good assets. They've got, to a certain extent, similar geology as Kazakhstan. They've got some of the sandstone roll fronts that are ISR amenable. So Mongolia does have resources that can be mined at lower prices. But Mongolia is also a newcomer country in the sector, and that comes with its challenges. Orano is successful in lifting some of those challenges. They're working with Mongolia to get the IEAA to approve the exports and everything else, and develop a sort of framework, a jurisdictional framework around export of uranium. But also Mongolia is wedged between China and Russia. And that's the reality, the location reality that you also need to take into account. What does that mean? To what extent can Western producers really play a role in Mongolia without working together, at least with Russia or China, on either throughput or as an off-taker or something along those lines? So I wouldn't say I'm skeptical about Mongolia. I think they have the possibilities, but it won't be without its challenges.
Yeah, agreed, 100%. Bram, what about transportation issues with the Trans-Caspian route? Could this be a big issue in the short term on the market? Could we see a lift in uranium price over that?
That's one topic that I don't know all that much about, because transport is, from a trader's perspective, transport is irrelevant. It's one of those things that gets done and you don't worry about it.
Okay.
But obviously we'd had to study a bit, because it's become a potential issue in the sector. Okay. Our view is that as long as St. Petersburg is open for business, which it currently still is, there's obviously no issue. And the preference at any Kazakh producer, bar Cameco, would be still to go via St. Petersburg, because it's the most cost-effective and the most well set up route. And then it's about timing. If tomorrow there's sanctions being put on Russia, or Russia retaliates and the St. Petersburg route is done, there will be a big effect, because the Trans-Caspian route doesn't have the capacity to take all of the Kazakh uranium in a year. There is blockers there. There's many countries that needs to play ball. There is limitations on volumes. The route works. We've seen it work, but it's a volume thing and it's a licensing thing, and it's obviously much more complicated. And then in the bigger picture, you've got the logistic issues that you have around shipping in general. Shipping of uranium is a non-value added business, but it's a critical part of the value chain. And that causes a problem. As a shipping liner, because the volumes of natural uranium are so low, you're not going to hang up your business on it. But it's a necessity, so somebody has to do it. And we see that there's less and less ships and vessel owners and insurers that are willing to go near uranium, they're willing to go down that route, which leaves the market exposed to chartered ships, to one or two insurers that can insure a vessel, and to a lot of uncertainty about sanctions being put on a ship by one or two countries. We've had the scare with Canada and the waivers for that particular Canadian flagship that calls in St. Petersburg. So it's something to keep an eye on, and something breaking down in that value chain will have a major effect. But at the moment, it's business as usual.
Okay. I would like to hear your opinion on Kazatomprom uranium production. Where do you think Kazatomprom production will go in the long term? And by long term, I mean, again, let's say 15 years. Do you see a similar ratio of diversification as today, or we could see a shift?
What do you mean with ratio of diversification? Just so
I mean, in terms of supplying east or the west, let's so to say.
Okay, I think they definitely want to. I think because of where they are in the world, they're always going to be a bigger supplier to China than they're ever going to be a supplier to the West. That just makes sense. But Kazatomprom will never be a sole supplier to either Russia or China, because they would lose all pricing power if they did. I think Kazakhstan is an interesting case study because it's been the Saudi Arabia of uranium. But if you look at the resources in Kazakhstan, they're much less stretched than Saudi Arabia. There's resources that are tailing off very rapidly in the 2030s. Some of the bigger mines have their resources depleted in the 2030s. And so there's a need for new resources. As with anything with mining, you go into the easier and more or the cheaper mines first, and then you develop the rest later. And I'm not saying there's a lack of resources in Kazakhstan, but it gets harder and harder. And so the Kazatomprom recognizes that as well, and the uranium sector is an important sector. So we genuinely do believe that the value of a volume approach that they're currently taking is something that's there to stay. We don't see them reversing on that pledge at all. What we also do see managers via what we're catching in the news and everything is that they're quite late on developing new mines, and any new mines that they are developing is with the help of either China or Russia. We're not seeing any pure Kazatomprom developed mines at the moment that are making any real good progress, and nor are we seeing some real big investments from the Western countries. Obviously, you have Katco and Inkai, the two large mines that are in joint ventures with Orano and Cameco that have stretchable resources that can stay on for a longer while. But I don't think we see the necessary investments yet to really keep Kazatomprom at the same level throughout the 2030s and 2040s. We see them really tailing off quite rapidly in the 2030s, and they need to do a lot of investment to catch up with that. So that's something to keep an eye on in the next few years. And then in the shorter term, they've obviously been communicating that they're going to go from -20 to -10% in 2024. They're going from -10 to 0 in 2025. The question is to what extent that's feasible. They are struggling to a certain extent with production rates right now. They still have some issues on the consumables, piping, and sulfuric acid. They're taking important steps to resolve those issues, but that is still a consideration to look at when you're assessing 2024 and 2025, and they probably know that as much as everybody else knows, that they're limited to a certain extent by their production capacity as well. So that's something to really keep an eye on. And if anything, if you're building your own supply demand model, I think the risk to the downside is larger than the risk to the upside.
Yeah. Bram, can you comment on the news? Not news, rumor that BHP has stopped selling uranium in the spot market?
I think it's a storm in a glass of water. It's whether it be a rumor or not, or it be news, it's more or less irrelevant. BHP was never an only spot market seller. They've always had long-term contracts. They've always been engaging with utilities. They've had a different pricing approach. That's true. BHP has never really been a fixed price supplier. They've always been a market price suppliers, because they believe that, like any other commodities they sell over the long run, if you just follow markets, you're going to outperform by trying to time the market and selling. It's a bit like how people approach the stock markets. Do we see BHP less on the spot market than we did see them a few years back? Maybe to a certain extent. Maybe we see them sell a few less pounds in the spot market, but it's not a meaningful difference. And BHP was never the reason why markets were trading down. BHP, they might have sold a few million pounds in the spot market at times, but it was never a real reason why markets took a dive. And that hasn't changed. But if anything, yes, they might have a few more contracts with utilities, which allows them not to have to sell into the spot market whatsoever. But it's not a major change. It's not a shift from. It's not like the 8 million pounds they produce from one day to the other went from the spot market all the way into long-term contracts.
Yeah. One question regarding new physical funds and that are coming to the market. Are they going to shake the market?
Well, I'm the wrong person to ask that question, because nobody's going to tell me about new physical funds, because we obviously work with a competing fund at the moment.
Of course.
So we're going to be the last ones to know. But I think
your general.
No, there was a lot of anticipation in September. There was going to be a few new funds launched, and to date we haven't seen any. So that's just something that I've noted. Whether there's still new funds that are out there that are going to come online, possibly. I know there's a lot of investor interest, and we see that through the AMC. There's a lot of money that still needs to find its way into uranium, and there's still money that's sitting on the sidelines to wait for the right time to enter in the uranium space. We see uranium as a commodity has been acting, or has been very positive, and that attracts the attention of the generalist investors. The investors in uranium right now are very specific investors with a view on commodities, with a view on uranium, with a view on energy. Yeah. We see more general investors coming in. So I'm sure there is room for many more funds or many more vehicles, or for the current vehicles to grow significantly, because when real money starts flowing, it flows in a big way. But I can't comment on where some of the other funds are, because, as I said, I'm going to be the last one to know. Okay,
fair enough. Bram, do you hold uranium equities in your private portfolio?
I do, yes.
Okay, do you mind me asking what kind of? I will not ask you the specific names if you don't want to talk about them. But do you have producers? Do you have developers, juniors? I mean, explorers or ETFs? What's your exposure?
All of the above, aside for the ETFs. I am personally also invested in the AMC, because I think it's the best vehicle to, as a private person, to invest in and get exposure to the physical market. But aside for that, it's all on the producer side, or producers and juniors. I am probably not somebody that you should replicate their portfolio, because I'm in the market and I'm a part owner of a company that is a physical trader. My profile is very different than most investors. But the way I look at it from an equity perspective is that you want to own some of the large names, the real large names, as the big producers, and then I own some of the really small names, the ones with like real big upside. I don't own very much in the middle, and that's by choice, because I do feel there's more risk in that trade than there is reward at the moment. Most of the middle tier names, they don't have cash flow yet, and so they don't have any dividend yield. They don't have any upside there. they have upside in pricing, but they're pretty well priced. Most like if you calculate on an NPV basis, most of them are priced at $70-80 uranium already. And so the real upside is in the price of uranium. I do appreciate that a lot of them can overshoot, and so as an equity investor, that's always something to keep in mind. But that means that you also need to time your exit very well, and that's something that I am not prepared to do. So I'd better put more money in physical uranium, where I know the story is unfolding and where I know that's the underlying story, rather than into that middle tier. And then on the larger producers, I look for dividend yield. Some of them have extreme good dividend yield and are natural hedges to an appreciating spot price. And then the real small ones that I invested in, they're sort of a put some money in it. If some of them actually start producing, great, and then you're gonna get the 10x. If they don't, it's money that you didn't need in the first place. I'm kind of taking that approach, but I'm not saying that that's the best approach for everyone.
Yeah. Final question, Bram. On what other commodities besides uranium, of course, are you bullish? And if you can name 3 or 4.
I'm a very big bull on copper. I think copper is an outstanding commodity at the moment because the world is heading with the green energy investment, and copper has been unfairly hit by the lack of growth in China. But the copper story is going to be unfolding on the green investment sphere rather than on Chinese building. I'm a very big bull on oil still, and on energy commodities, on coal, oil, because I think those are necessary as we go through the energy transition, and the world is starting to realize that renewable energy is not without its faults or not without its challenges. We're going to need oil and gas and coal, sorry, for much longer than anticipated. And again, those kind of commodities have been unfairly hit. And then oil specifically, it's you've got all the geopolitical challenges and how it's being used as a geopolitical tool around the world that could probably give it more upside than it's got downside. So those are, I'm really looking at the energy commodities on one end, and then sort of copper, a bit of zinc, a bit of nickel, to a lesser extent, and like the base metals I like as well. I'm not particularly bullish on either gold, silver, lithium, some of those like the other commodities that have been touted around there, and I see on the background, your background as well. A bit more cautious on those, but copper I'm a big believer in for sure.
What about uranium co-products, vanadium, rare earths?
Rare earths, yes, absolutely. But rare earths is again a very geopolitical play. So, and quite frankly, I don't know enough about the different types and different concentrates of rare earths. I understand that there's a lot to do with the processing capacity.
Yes.
And when your bottleneck is not your mining, but it's your processing capacity, then I'm always very cautious about the mining side. It's something to be aware of. And then what was the other comment? So you said
vanadium.
Vanadium has had some wild runs. Vanadium I'm staying away from purely because vanadium is a byproduct. In most of the mines, vanadium is a byproduct, which means that it doesn't have its own economical rationale on most mines. And therefore, it's very hard to invest in, because a big mine can go online, and take uranium as an example. As a uranium mine has a big output of vanadium that they're going to use as secondary credits. And it just alters the vanadium supply demand without necessarily being subject to a proper economic analysis. So I stay away from vanadium for that reason.
Okay, fair enough. Bram, I want to thank you for being my guest. It was a great chat, and I look forward to do this again sometime soon.
Absolutely. Thank you very much for having me. It's been great.
Thank you.